Yeah, I mean, I think it was understandable to see, China reopening and that's going to be a bit of a tailwind to global growth this year. But I still think there are multiple headwinds, especially for advanced and developed economies, mainly because interest rates have moved substantially higher over the last year. They've gone from basically nothing in most developed economies to sort of 4 or 5%. And the toll that has on an economy from an economic perspective does take time to come to fruition. And so I think that will continue to put large economies under significant pressure throughout 2023.
And in those unusual windows where good news is bad news when it comes to markets. And as we take a look at this economic growth picture now, it does make you wonder whether this could be bad news in the sense that interest rates could be higher for longer.
Yeah, I mean, I think the market has moved quite a lot over the last couple of months in terms of expecting what the Fed is going to do. I mean, the market has moved to a quite dovish position and thinks, we're only going to expect a quarter of a percentage point rise to tomorrow, and then maybe one more in March, and then, it'll be cutting at the end of the year. And this deviates quite a lot from the Fed dot plot, who can see that they'll be tightening sort of past 5% and interest rates will be staying sort of where they are well into 2024. So I think this week's actually quite a big week for markets. We've got three central bank meetings where I think this sort of dovish or hawkish narrative will, finally come out. I personally feel markets maybe have got it wrong. I think the Fed has been very resolute in trying to battle inflation, have been very clear that they will remain hawkish until the job is done. We've also got about 20% of the S&P 500 reporting this week. And of course, we've got the non-farms on Friday as well. So I think this is quite a big week for shaping the narrative for the coming couple of months in the investment world.
Couldn't agree more, Dan. Let me ask you directly about the UK, because this is where the really bleak numbers have crossed. The only major advanced economy seen to be in recession this year, 0.6% fall in GDP. What does that mean for the Bank of England?
I've said it for a lot of last year, but the Bank of England is in a really tricky spot because growth in the UK hasn't been as resilient. And I think it puts further pressure on them that whilst inflation is so high, but growth is so weak, it puts them in a very tricky spot to keep raising interest rates. Clearly the battle with inflation isn't done, and they need to be shown and seen to be, winning that and taking it seriously because their credibility is at risk here. But it puts them in a tricky spot. In an ideal world, you do not want to be tightening monetary policy when you're already in a recession or you're going into a deeper one, as the IMF has suggested. So, it'll be very interesting over the coming months to see at what point they pivot and recognise that they need to be slightly looser with policy than tighter.